Several risks are converging, and no single sector is guaranteed to trigger the next downturn. But patterns are emerging. Corporate debt remains a pressure point. U.S. companies hold more than $12 trillion in debt, much of it taken on when rates were near zero. Now, as refinancing begins, companies are facing rates 2 to 3 times higher. This affects firms in real estate, retail, and manufacturing that operate with tight margins and high borrowing needs. Commercial real estate is already strained. Office vacancy rates in major U.S. cities remain above 18%, and some buildings have lost up to 40% of their pre-pandemic value. If defaults rise, regional banks with large exposure to these loans could face instability. At the same time, geopolitical tensions are rising. A broader war involving Iran and Israel could send oil prices surging. Iran produces about 3 million barrels of oil per day. Even a short-term disruption could push global prices back above $100 per barrel. Reigniting inflation, that would raise transportation and food costs across the board. Energy-sensitive industries like shipping, airlines, and logistics would likely face higher input costs. Consumers would feel it in gas prices and grocery bills, which are already elevated from the last inflation wave. Another round of inflation could force the Federal Reserve to delay rate cuts or even consider hikes. That would prolong tight credit conditions and limit growth. No one knows the exact trigger, but the risks are clustered in sectors tied to debt, energy, and global supply chains. The best preparation is awareness. Watch for tightening credit, rising input costs, and shifts in global demand. Follow for more grounded financial insights, because your money deserves clarity, not confusion.